Hello and welcome to the VentureForth podcast. I'm your host, Joe Mahavutivani. We'll be chatting with some of the most interesting founders, startups, and VCs about the experiences that led them to where they are today, what they're currently working on, as well as the journey ahead of them. On today's VentureForth podcast, I'm very excited to welcome Jeff Clavier, managing partner at SoftTech VC. As one of the original so-called super angels or micro VCs, Jeff is a legend in the Valley and has seen it all. Jeff knows how to pick winners, and some of his most notable investments include Mint.com, Fitbit, Eventbrite, Hired, Postmates, Poshmark, About.me, and many, many more. SoftTech most recently raised $150 million across two funds and is focused on seed and growth stage investments, but occasionally writes larger checks for the most promising companies. I'm intrigued to hear about Jeff's background and about what he looks for in successful founders that helps him pick out the big winners. Welcome to the show.
Thank you, Joe. I'm so excited to join you today.
Awesome. Well, I'd love to start by hearing a little about your background and the road leading to SoftTech VC.
Sure. So, born, raised, educated in France, have a Master of Science in Computer Science and a research degree in distributed computing. Did a startup in the financial services market that brought Sun workstations in trading floors in the late 80s when those workstations were the most powerful gear you could put on a desktop. I was the CTO of the company, and ended up being acquired by Reuters in 1992. I stayed with Reuters for a while, built a bunch of products, services, infrastructure for them. I had developers in Paris, New York, London, Palo Alto. And after going through the Euro transition, the millennium, which went fine, I moved to Silicon Valley almost 17 years ago to become a VC with the corporate venture arm of Reuters, which was called the Reuters Greenhouse Fund. Those guys had invested in Yahoo, VeriSign, Phone.com, a bunch of Web 1.0 companies. And I stayed with them for 4 years before I saw the emergence of this new generation of companies that was at the time called Web 2.0. And, they had beautiful sort of dynamic interfaces, and they were very capital efficient, trying to build a product for, just a few $100,000. And what's bizarre when you look at the activity at seed stage today is that 13 years ago, there was just a handful of people actually interested in funding these guys or gals, and decided to essentially have a go at it. So left Reuters, started SoftTech, and played full-time angel investor for about 3 years. That's how I became one of the so-called super angels with a small fund, because it was just, my money. So my wife was the original LP of SoftTech and made 24 investments. You mentioned Mint. Truvio was my very first investment, the first video search engine before YouTube even existed, and had a streak of successes that led me to raise one of the first micro VC funds, or what's now called micro VC funds, in 2007. It was what we call Fund 2. It was a $15 million fund that was raised in about 8 weeks in the summer of 2007. That fund made 65 investments. That's the fund that seeded Fitbit, Eventbrite, SendGrid, Wildfire, and a bunch of other companies that were successful. So it's a very successful fund. And then raised in 2010 one of the real micro VC fund with a real VC-like portfolio construction strategy. So you invest for a certain ownership target, you reserve for Series A and Series B, pro rata, and so on and so forth. So it was Fund 3, which did 55 investments. That's the one that did Hired, Postmates, Poshmark, Clever, ClassDojo, and a bunch of others. Then we raised the bigger brother of Fund 3, Fund 4, $85 million. 2013 to 2016 kind of vintage. That one is, still work in progress. We've invested in 42 companies. So as we grew older, we decided to concentrate our portfolio a little bit. So that portfolio only has 42 companies, but those companies we own a lot more of. So average ownership is 7 to 10%. And as you mentioned, we raised 150 million early 2016, 100 for the seed fund, 50 for an opportunity fund that only invests in existing portfolio companies when they reach sort of a higher degree of maturity, Series C, Series D typically. And so now, out of Fund 5, we write an average of $1 million check. We take 7 to 10% ownership, and we are part of, and we're happy to lead, co-lead, or follow in a seed round that will be typically 2 to 3 million for a software company and 3 to 4 million for a hardware company.
Wow, that is an amazing history. Thank you so much for sharing that. I kind of want to touch on the sort of super angel micro VC thing. Those titles sort of have gone away since, but I know that, so I work with Howard Linton, and Tom Peterson at Social Leverage. Yes. And they were also sort of included under that umbrella. And so I read in a 2011 post from SoftTech's blog that the title of Super Angel really was a bit of a misnomer since you were investing other people's money. Was this always the case, or in that, I guess, original fund, was that an angel fund?
Yeah. So the Super Angel moniker, which was invented back in 2006 for a piece that Business 2.0, which is now defunct, sort of wrote about, the 13 super angels, and they had a bunch of people who were investing their own capital into early stage startups. So angels invest their own capital, VCs invest other people's money, right? OPM. And at the beginning, for the first 3 years, Fund 1 was essentially investments I made out of our balance sheet. We made a little bit of money at Reuters when we sold our company FX and then afterwards. But we had made, bank, like some of my friends had done by being very successful entrepreneurs or being part of early stage successes. And so for us, the $250K that we had allocated to this pocket of investing was actually very, very meaningful to us. It would have been trouble if I had lost everything. And so the super angel thing sort of worked for me until 2007, when I raised my first institutionally backed fund, because then I started investing other people's money. Obviously, my money was also in there, but it was largely other people's. And I think where people still used super angel as a denomination for what I was doing and a few of my friends were doing is because we were still doing angel type investments. So as an angel, I would be writing a 25 to 50K check in a bunch of startups and rarely, following on. As the GP of Fund 2, I was writing 100 to 250K checks and I was rarely following on. So it was kind of an angel strategy applied to an early stage fund. Which is why I said, well, Fund 1 is definitely a super angel thing. Fund 2 is kind of a super angel strategy. And Fund 3 was a real VC type strategy on the low end of check sizes, which is why we call them micro VCs. I think my friend Mike Maples came up with the term micro VC because we had, a portfolio construction which was fairly well defined. We had a target of ownership in those companies. We're trying at that time to get 3 to 5%. I started to actually lead rounds and take board seats in the course of Fund 3. And we had an explicit follow-on strategy where if a company was successful, we would definitely write a check at Series A check at Series B, and sometimes a partial check at Series C. The Series C bit has been replaced by our opportunity fund, SoftTech VC Plus, which allows us to write 2, 4, 5, 6 more potentially $1 million check. So that's why at the beginning, as we ramped the size of the funds and the size of the investments, people still confused a little bit super angels and micro VCs. Now it's pretty clear. If you invest other people's money, then you can't be a super angel. And there are very few super angels left because most people who've been successful investors have been raising funds because it's definitely the thing du jour. Joshua Schachter, my good friend and limited partner, so someone who invests with in us and with us, is actually one of a few super angels left because he still invests, his own money 10 years later.
Wow, that's amazing. Like, I've interviewed tons of investors who've been part of these larger funds, but less often to investors who are deeply involved in their own fundraising. Can you talk about what goes into raising a fund and how size and stage affects those challenges?
Sure. So, and you learn by doing, and it's typically sort of horrible. Of everything I love doing about my job, fundraising is the thing which I'm least, sort of enamored with. So when I did Fund 2, which was, April, May of 2007 is when the conversations with potential limited partners sort of started. There was no blueprint for what we were doing. There was no model. Josh Koppelman, who's really patient zero in the whole micro VC world, had raised a fund on the East Coast, first round, Capital One, which was the first, real sort of fund that defined almost sort of the model. In Silicon Valley, there were a few of us that were sort of about to do the same thing. And so when we were talking to institutional investors, they were like, why the hell would you raise a $15 million fund? That doesn't make any sense. And so I was lucky to find friends essentially who were supportive and interested in backing what I was doing. So I collected a bunch of 100K checks from friends and I limited the check size to 100K because I said, look, I'm not sure I know what I'm doing, so I don't want to lose too much of your cash. So I sort of told people, don't give me more than 100K. But then I had two institutional investors. One was Norwest Venture Partner, which, is a VC firm that actually backed us to get exposure to the seed world that was developing at the time. And then a small fund of fund, Darwin Venture Partners, also wrote a large check size, given that I had very limited track record. So I raised $12 million in change from institutionals and then $3 million from angels, and that was it. As I progressed through the history of SoftTech and raising, bigger funds, so 15, 55, 85, 150, we basically started to institutionalize our LP base. And now we have about 20 institutional LPs that have anywhere from, 3, 4 million to 20 million exposure to our funds. I would say if you try and raise a small fund, these days you have people raising $2, $3, $5 million pre-seed funds. So they invest before us. We write, $1 million check as part of a $2 to $3 million round size. That's what I define as seed. Pre-seed would be a $500,000, $750K kind of friends and family type round that only invests at almost ideation stage. So you back a couple of founders and then you help them figure out the concept and build the initial product. For those pre-seed funds, you can basically go around to individuals and try and get a 50, 100K check. And that's how you build the initial infrastructure of your financing. Because it's hard to get any institutional for less than a few $1 million, and they never want to be more than 5 or 10% of your fund. So the math just doesn't work. And also, very few people want to back an emerging manager unless you have a real track record. So how to unlock that is demonstrate two things. One is that you have a unique theme, because there are so many funds, 300 to 400 seed funds now, that it's very difficult to be a generalist fund. Like we are a generalist fund. We invest in SaaS, B2B, enterprise. We do connected devices, marketplaces, a little bit of monetized consumer, and then frontier tech, things like AI, AR, VR, robotics, autonomy, and things like that. And we can't afford to do so because we've been around for a long, long time, and people sort of know that we've had successes in all those categories. So we can afford not being super focused and have what I would call a shtick. But if you're starting something today, you need to have that shtick in order for founders to basically recognize that it's worth them coming to you for capital, but most importantly, advice and value add, so you can actually help them get to the next stage, right? This is the job of early stage investors, is take a company where it is and help get it to the next stage of financing, next stage of maturity, next stage of scale.
Definitely. I've had the opportunity to be part of the conversation and help out wherever I can as Social Leverage raises Fund 3. And so it's been really eye-opening to see that process. So yeah, that's been really neat.
And it's frustrating. It takes a long time. And yeah.
Yeah, I've definitely heard that this is not as glamorous as a lot of people make it seem, especially when you see so many funds out there raising, these big funds, and then you got the Andreessens of the world got like over $1 billion in each round. So on that topic, there seems to be tons of seed stage capital in the market these days. As I mentioned, like there's so many funds raising $50 to $150 million funds to do that. What makes SoftTech different, and what is the greatest benefit that founders gain from partnering with you?
Sure. And yes, I would say there's a very large number of funds that are raising 10, 20, 25 million in that sort of range. And then they come back after a couple of years to raise a bigger fund. And so you still have like the number of funds above 75 million, which is typically what you get to with, fund 3 or fund 4, is still fairly limited. There's, a couple of dozen, but it's really where is the sweet spot for a lot of the early entrants. So to answer your question on SoftTech, I think a few things. One is, the track record and the brand that we've built over the past 13 years help us, A, attract founders, B, attract, follow-on financing, which is, as I said, one of the most important things that we help our founders with, which is get them to a great large Series A with a great, Series A investor who will help them get to the next level, which is basically build a company and raise a Series B. We will help essentially on all fronts, whether it's building the product, building the team, building the infrastructure, helping them to think about the early stages of scale, provide them with a very clear roadmap of what they need to hit in terms of numbers and type of team, to forcibly sort of raise a Series A. We never know what it takes, but we have a good hunch of what is needed. And so we help them sort of get on that journey so that when we feel they're ready, we're going to bring them to visit with VCs, and we know exactly who will be the right VC for a hardware company, for a software company, for a marketplace company, because you don't always sort of talk to the same firms and the same partners, so that we maximize the likelihood of raising a large Series A. Our average Series A is $10 million with some of the best firms in the market. And it's our ability to do that, which is recognized in the market, that makes us sort of different. A lot of founders will come to us and say, well, I'm raising, say, $2 million and I have $1 million or $1.5 million already, circled, but I don't have a lead, right? Yep. And the job of the lead, yes, is to define the terms and price the round, but that's nothing compared to actually sitting down with the entrepreneur on a bi-weekly basis and actually helping her or him to build their company. And that's what we do. We're happy to lead, co-lead, follow. Actually, for us, we don't have any ego. We don't need to be in the lead position. We just want very strong investors who can help. The company will offer a ton of value add. And if the founder wants us to do so, we'll take the board seat and, we'll stay on the board until the closing of the Series A or the closing of the Series B. We will sort of deploy our resources. We'll sort of do, and we have zero ego, so we'll be happy to do anything that we can to help a company be successful. Might be, helping with interviews, trying to convince team members or executives to join the company. That could be, opening a Rolodex to find potential sort of customers. Like anything that we can do to help the company is what we do, which is why over time we have compressed a little bit the size of the portfolio so that we can actually go deeper and spend more time with our portfolio founders. And right now, we're going to see roughly 3,000 companies a year. I mean, 2,000 to 3,000 depending on the year. And we're going to invest in 12 to 15. So we say no 99.5% of the time, which means that each of us, partners, there's 3 of us in the partnership, will take on 4 to 5 new companies a year.
Right. Yeah, I've definitely had some of those conversations even this week with founders. So that's really interesting to see sort of your take on it. And obviously, like any company would, I think, be fortunate to have you on their cap table. So now that you've raised that latest fund, you mentioned that it was a generalist fund, but are there any sectors that you're sort of bullish and investing in today, and perhaps more interesting, sectors that you're cautious of?
Well, we're cautious as a team in general. So I think we would pretty much sort of look at anything that has, super strong founders with a unique insight, like a differentiated product and a real market opportunity. So we sort of can convincingly draw a path of how the company gets to $100 million or north of $100 million in revenue, net revenue. So I sort of mentioned the sectors we invest in. SaaS B2B enterprise is a lot of what we do. So whether it's software infrastructure, whether it's vertical SaaS, whether it's the application stack, whether it's developer tools, we'll do all of this. And we've had very successful companies and outcomes in all those sectors. On the back of our success with Fitbit, we've done a lot of connected devices, and we continue to do so. In the last couple of years, we've added companies which are more on the industrial side, and we're super excited about what we have in the category. We continue doing marketplaces, both B2C and B2B. We do less and less consumer. I started in the consumer side, but these days, it's very hard for us to be excited with like anything social networky or photo sharing or messaging except if it's really a very specific sort of application where we see an opportunity to monetize. So that's what we call that monetized consumer. And then where I'm super excited, because that's where I spend a lot of my time, is sort of the new areas of frontier stuff. So whether it's, artificial intelligence. So the theme is rise of the machine. So whether it's robots, AI, AR, VR, autonomy, whether it's cars, trucks, but it could be also, robots. There's a ton of things that we look at where, they're really at the edge of our comfort zone. So recently, I've invested in a next generation microprocessor, which is a first for me, and I'm super excited about that. But we looked at a quantum computer, and that was just too much. The key challenge for us seed investors is that we always have a finite runway and, limited capital to actually prove a company. Like whether it's 2, 3 or 3, 4 million, it's still, you have roughly 18 to 24 months to prove yourself. And for a lot of edge science or really expensive type experiments like quantum computing, seed financing is not really sort of the way to go. So I passed on that quantum computing, opportunity. Looking at some material science deals, looking at a bit of bioinformatics. I think that we've done, a decent amount of healthcare type investments over the years. And I think that biotech and bioinformatics is really at the edge of a revolution, and there will be a lot of interesting opportunities in companies being formed in the next, 10, 20 years. So that's the edge stuff. And we sort of try and balance the amounts and the risk that we take, where I would say 80% of our portfolio goes into our companies or portfolio are in sectors where we sort of understand the outcome and the science and how it's done. It's basically execution risk and figuring out sales and marketing. And 20% is sort of batshit crazy where you don't even know the science is going to work at scale. And, we're comfortable doing that because over the years, we've proven to our limited partners that it was not such an insane strategy. And we actually sort of are pretty good at spotting trends and teams that can actually sort of build category defining products. So that's sort of what we do. What we don't do, e-commerce, we just suck at e-commerce. Like my partner Steph brought us Dollar Shave Club when they were raising their seed round, and we said, but it's just a marketing play, it's just a stupid video. I mean, Michael Durbin is a genius, and the video was great, but we didn't see any defensibility there. And $1 billion later, clearly it's on Steph's entire portfolio. I think we have an issue with travel. We've looked at dozens of deals in the travel space over the years, and we've done a couple, and we just don't get travel, I think. So there's a few discrete categories like that are hard for us to get excited about or to be convinced about. But otherwise, we'll be very broad in what we do. And it's sort of super interesting and intellectually, but also from just a risk distribution, it's a way for us to mitigate, where we put our eggs. They're definitely not in the same basket.
Definitely. Yeah, and so actually you mentioned Dollar Shave Club and, kind of passing on that opportunity. And I was curious about how social proof plays into your decision making and whether that has ever caused you to miss a deal that you, I guess, now regret.
What do you mean by social proof? Who else is investing or
Right. Exactly.
How much? So we have a rule at SoftTech is that we don't care at all about who else is investing. We actually never ask founders about who else is investing. If there is a lead and a term sheet and that would follow, obviously we ask, who that is and what the terms are, because that is important. But otherwise, we don't care. We make our investment decisions independently. That's why we lead a ton of our deals, is that we end up just being the one that set the terms and then rally other investors. And often companies come to us and they have a little bit of their round filled. We commit to invest, we put down a term sheet, and then within like a few days, everything is oversubscribed because people sort of see us investing as a positive sign for the potential fate of the company.
Definitely. I'm guessing that social proof certainly influences other firms' decisions, having SoftTech on board. So you recently did a talk at the NewCo conference about startup founder fundraising. Can you talk a little bit about how green but promising founders can determine a valuation and dilution and the other issues they may face when raising for the first time?
Sure. So I think that the thing to understand is at the end of the day, you're going to leave a piece of the company on the table every time you raise capital, and you have to be thoughtful about, how much of that dilution because it's more about dilution than valuation. Valuation just is a byproduct of the dilution. And it's really sort of a measure of the value you get. Sometimes people would get hung up on, well, should I take a 7 million pre or 8 million pre or 9 million pre sort of valuation? Well, it doesn't really matter. What matters is what's the dilution that you incur. So a 20% dilution is better than a 30% dilution. But if you have a party round of, 20 people giving you $2 million for 20% dilution, or Sequoia Capital, I'm just giving extremes, or Sequoia Capital that offers you, the same amount for 30% dilution, you'd better take Sequoia because, their help will be able to really push you further in terms of how you can hire, how you can build the company, all the advice, the brand associated, and so on and so forth, right? So typically, a seed round will be 20-25% dilution. You will build an option pool that is, depending on what you need to hire, the depth of the team, executives, and so on and so forth, between 10 and 15% post-round. And before that, you may have done incubator, you may have done a pre-seed round, and pre-seed rounds should be in the 10-15% max. And then when you raise a Series A, you look at, another 25% dilution plus a potential re-up of the option pool. So if you sort of stack up all this dilution, then the founders will end up already, after the pre-seed or accelerator, the seed round, and the Series A, they will end up with less than 40% of the company. So you have to be really mindful from whom you raise and how much you raise to do what. Our advice to entrepreneurs is always think about what you need to clear the next milestone. And so that's why our rounds tend to be larger and a little bit more dilutive, but they will sort of get you to milestones which are higher and will allow you to raise larger sort of Series A's and Series B's. The valuation is always set by the market. So as a founder, you shouldn't, unless you have someone giving you a term sheet saying the valuation is blah, then you shouldn't sort of set the terms. You should just say, well, if someone asks you, do you have any valuation expectations? You just say the market will just price the opportunity based on everything we've done and the potential of the opportunity. And sometimes investors will be comfortable giving a higher valuation and invest more money for the same dilution. Say, $3 million on 12 pre, 15 post. If you are looking at a very experienced team that has already built a product and has gotten a little bit of revenue proof points, and if it's like super early and very risky and the team is green, then, you may end up with a 6 pre valuation or less and raise, $2 million for a 25% dilution. And so all this math is something that founders have to get used to and be comfortable with. But I will repeat that until I can't speak. It's all about, the strength of the investor syndicate and the value that they can deliver through their investment. Capital is a commodity. I mean, at least in Silicon Valley, because you have so many sources of capital that the difference is really what are the different sort of things that your founders or your investors can do for their founders. Obviously, in other parts of the country where capital isn't a commodity, then raising capital is the first objective, and then getting value is sort of the cherry on the top of the cake. In Silicon Valley, in New York, Boston, Seattle, and a few other centers, it's really about the value add.
Right. You mentioned actually that there's a ton of capital here in Silicon Valley, and that's kind of a commodity. And there's a lot of people doing angel investments or raising small funds now from colleagues, for instance, like people coming out of Facebook or, who will be coming out of Uber, Airbnb, and the like. How is that affecting the prices and how much money people are investing or actually raising?
Yeah, that's a great question. I think I used essentially that sentence in a report. So I just sent to our 100 plus limited partners our reports for Q4 2016. And I always write a memo, page and a half memo about either something I want to talk about or sort of the outlook for the year. And I basically said, because of the overflow of capital at seed stage, we face a lot of, it's not really sort of competition per se in terms of getting us to miss the deals or lose the deals. Whenever we express interest in investing, 90% of the time, we get to invest. But we don't always invest at the price which we would have, set for the company. So it's like, good news is I get to invest. Bad news is I get to invest at someone else's price who was willing to write, a check at a much higher valuation than I would. And I think that it's the fact that we've been around for a long, long time. My first investment was at 3pre, and, we did really, really well on that 3pre investment. And I just know how hard it is to return, a fund multiple times. And if ever your initial sort of valuation is too high, that's going to hurt your performance. And so I can already tell you our funds, the most recent funds, are handicapped from a performance basis compared to our earlier funds because the valuations at which we invest are just much higher, right? Just mechanically and mathematically, our funds won't do as well because the valuations at which we exit haven't really sort of increased in a material way compared to 12 or 10 years ago, whereas the entry valuations have actually materially increased. But it is what it is. And so the way we mitigate that is we no longer really think about purely the valuation. We think about the actual ownership. And so we go for 7 to 10% ownership. And, that means that for us, whether we write $1 million check for 10% or a $800K check for 10% or $1.2 million check for 10%, it's not the same, but it's kind of, the same. And that's why we have bigger funds as well. And so, it's kind of interesting chicken and egg question, which is, did we end up with much larger funds because the rounds became larger, or did the rounds become larger because everyone had bigger funds and therefore wanted to invest more?
Right, definitely. I've been seeing more and more, and so it's really interesting to get your insights on that. So actually this is my last question prior to the quickfire round, but I'm interested to see your thoughts on whether Silicon Valley can be replicated in other markets, whether it's, domestically in the States or even internationally, because it can't just be the lack of VCs and funds and stuff. Like Bradfeld's got some interesting thoughts on this, but I'm interested to hear what your thoughts are.
So my take is that it's actually sort of not the right way to ask the question, because I don't think that Silicon Valley per se can be replicated anywhere. Because if you think about what is Silicon Valley, it's just this crazy concentration of two world-class universities, Stanford and Berkeley, 40 years or 50 years of developments of world-changing sort of companies over the years since the 1950s, 1960s, and that sort of concentration of capital, talent, experience, expertise, and risk appetite that is just has built this ecosystem in sort of a unique way. And so if your goal is to replicate Silicon Valley, you will fail. And I've said that to many governors, many mayors, many heads of states, because that's just not the way to think about it. The question is, how can you replicate an ecosystem that actually fosters innovation, right? And it doesn't need to be at the scale of or magnitude of Silicon Valley to be successful and useful. And so, back in 2009, 2010, we started to invest in the New York ecosystem, which in my view, sort of really developed on the back of the financial crisis, because suddenly you had tens of thousands of developers in the New York market that could no longer be hired by the banks because the banks didn't have any capital. And so suddenly you could actually find developers in the market and build a startup ecosystem around it. Boston is certainly sort of back, and we started investing in Boston 3 years ago. And so we look at Boston as if it was sort of a New York, sort of East Coast kind of makeup for us. And that's, 10-15% of our portfolio is there. Then we actually are very concentrated from a geo perspective. So we do Silicon Valley, New York, Boston, and then we actually look at Canada as a really interesting sort of ecosystem in development where we've done 5 investments to date over the past, few years. But we barely sort of do anything in the middle. And it's not that we're not interested to look at in companies there, but the ecosystem is so nascent and there isn't this easy Series A, Series B pipeline that we know we can have in the sectors where we invest, that it makes it sort of worth for us to sort of look at opportunities. It's kind of interesting because that's a very sort of Silicon Valley centric sort of view of the world, which is being challenged, I would say, in the last 2-3 years by interesting developments in Seattle, Portland, certainly Boulder. We've done a bunch of deals there. We just haven't done anything for a while. Texas, and so on and so forth. The problem is, for us to find the best Atlanta company, for us to find the best somewhere in the Midwest sort of company, we'd have to spend time in the ecosystem to get to know people, build those relationships, get, the deal flow pump going. And it's just not worth our while, because if you look at the companies we find, or the companies that find us in the different ponds where we fish, we think that we just have the best return on time kind of, return on time sort of ratio.
Definitely. Cool. Well, with that, I'd love to kind of jump into our quickfire round or get to know a little bit about you. And so, I'll say a statement and, really first thing that jumps into your mind, be great to hear that. All right, let's start out with, what is your favorite book?
Dune. I've read it many times. It takes a while because I read all the different books of the 4 or 5, but that's this sort of science fiction sort of fantasy world, which I'm always sort of fascinated by.
Definitely. I haven't read Dune, but I'm a huge sci-fi fan myself, so I can certainly appreciate that. What band or artist would you travel 500 miles to see?
That's a good question. I don't think I would travel 500 miles for any band or artist. I would go to a concert here, but I wouldn't travel. Nah.
Yeah.
I would. No, hang on. It's not true. Technically, it's not true. I actually traveled to New York to see Hamilton.
Oh, there you go. Yeah, definitely.
Okay. So I guess Hamilton, but that was the only one.
Awesome. I'm actually here in New York for Stocktoberfest now, and Tom Peterson actually saw Hamilton, it was like 2 days ago. So that's something I need to see at some point in my life.
Oh yeah, it's absolutely worth it. Absolutely.
Awesome. So now you've got like the world's greatest job, but what was your dream job as a kid?
So when I was 12 years old, I wanted to be a chef. I wanted to go to cooking schools and be a chef. And we went to see a career advisor at my school, my middle school, and said, hey, this is what I have in mind. And the guy sort of looked at my grades and he saw that I was a straight A student, and he looked at my mother and said, there's just no way we're going to let him go to cooking school. He just should do like the best students, math, physics, German, English, Latin, and that's it. And so that's what I did. And so we'll never know whether I would have been a crappy cook or a world-class chef.
Yeah, I mean, you're French, right? So, I mean,
Yes, I was born French. Yeah.
Yeah, so, I mean, like, some of the best chefs in the world are from France, and certainly, like, the most sophisticated cuisine, too. So, I have no doubt that you could maybe swap places with, like, Eric Ripert.
Well, I think I'm happy where I am, and I can sort of cook for my friends. So I think it's not too bad. But that's kind of interesting. It's in France, you have either, like, in order to go to professional school, you have to fail at traditional school, which is sort of really stupid. I like the German approach much better.
Actually, now that's interesting because I love cooking myself. What is the German approach to that?
Well, the German approach is more like to consider that whether you go to traditional studies or professional studies, there's no notion of one being a second grade citizen. And so, they foster and really encourage kids to go to learn a trade the same way they want you to go and learn, math and physics and CS and so on and so forth. The issue in the French system is there's a clear set of courses and curriculum you have to go through. And so for example, the best students were always sort of doing German as a first language, English as a second language, and Latin as a third language because they were given the best teachers. And so that's why I used to speak German fluently, and it's completely freaking useless. Whereas, if I had learned English as a first language, maybe I wouldn't have that stupid accent. And second, I could have learned Spanish, which would be way more useful living in California. So it's really sort of it doesn't sort of give you a real sort of flexibility as to what you want to do. And we tried to avoid that with our children. So when he was a junior in high school, our son went to sort of it's called middle college, where you basically sort of, as a junior and senior in high school, you take college level courses, which means that you can actually have access to the entire curriculum of the college. And that gave him the ability to sort of see what he was truly passionate about. And as opposed to doing business like his mom or computer science like his dad, he's basically into political science and is arming himself to become one day an elected official. And I think that it's a great benefit to give kids this flexibility that I wish I had when I was younger.
Oh, that's very fascinating. Thank you for sharing that. Actually, I like to learn new things about all things, and so that's definitely something that I wasn't aware of before. But that's very cool. So this is my last question before giving you the opportunity to plug anything that you like. But it's a little bit of a heavy hitter. So if you could be the CEO of any company for one day, what company would that be and why?
If I could be the CEO of any company for one day, which one would that be and why? It's interesting. It's funny. I have a go at Twitter because it has so much potential. It feels so fucked up that I would really want to go undercover and see whether there is any sort of quick fix. I'm sure there's no quick fix, but I don't understand how it can be, sort of in the state it is, where it has so much potential and so much importance. So, like, off the cuff, I would say Twitter.
I definitely feel like Twitter could be much bigger and more valuable than it even is today. And for some reason, part-time CEO and I'm sure in your one day as CEO of Twitter, you'd be a full-time CEO. It seems like
it's always way harder than you think. And, it's a bunch of very smart people who have been sort of working on this for a while, but it's just, bizarre to see that sort of asset, being a bit squandered. So, but it's like, the workout person in me, would love to sort of just understand. So, but, I'm sure if you ask me tomorrow, I will have another one. Because if I wasn't working in the VC trade or in the startup trade, I would probably work in the wine trade. So I'm sure I can find, like, being Aubert de Villaine, who's the guy running Domaine de la Harmonie Conti, would probably be a good gig for a day.
Interesting. Very cool. Another sort of, I guess, being in California and, from France is just an appreciation of great wine. So I can certainly empathize with that.
Oh, wait. So, yeah. So those who know me know that wine is my number one passion.
Oh, interesting. So why haven't you pursued that, at least casually, I guess, winemaking?
It's a great question, and I think it's very expensive. It takes a lot of time, and my sort of dedication is really to my work and my family, and I'm blessed to have, you know, a fantastic sort of wife who lets me work very, 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 very long hours without complaining. And, you know, I think that I just don't see where I would be able to carve out the time to properly, and, you know, I don't do something to half-ass it. If I do it, I do it fully and I do it well. So who knows? I'm turning 50 this year, so maybe not for this decade, but maybe to the next. I don't know. But, you know, I definitely enjoy wine tasting and collecting a lot. And so one thing I may try and do one day is to pass a sommelier. Like that's one thing on my bucket list. Might be like the SOM exam one day, but, you know, when I don't know when I would find the time. So I would need to just get more free time, which is nowhere near on the horizon.
I did watch Som Into the Bottle on Netflix, and so
it's pretty cool, huh?
It's
I really
fascinating.
Yeah,
they can pick out, you know, where wine, you know, the region, the weather, the day that you know, it's amazing talent.
Well, it's amazing talent, but it's all about being able to take the different sort of inputs, which is the nose of the wine, the look of the wine, and the taste of the wine, and have this sort of, you know, tasting bank, which you only can build through tasting thousands and thousands and thousands of different bottles to be able to sort of train your palate to recognize the different characteristics. So call it like an excuse to actually drink even more. But, you know, just to be clear, you spit everything. Like my record, I think, is 150 wines in 3 hours, but you don't drink anything because otherwise you're under the table, you know, after like an hour of the exercise.
Definitely. That's so cool. And so I'd love to give you the opportunity to plug anything that you like or anything that you would want to impart as last words with our listeners.
Yeah, I think, you know, it's always sort of super interesting for us to share our experience. The one thing which I've always appreciated is that this is a community which is very supportive, and we have a general approach to try and help people who want to join the industry. I think it's potentially what the new generation of VCGPs have is that we don't try and be productive. We try and, you know, share with others our experience. I learned that from Brad Feld, who I've been very lucky to be a mentee of since the beginning of SoftTech, and I've really sort of benefited from his friendship and openness. Same thing, John Callahan. Same thing, Josh Koppelman. And therefore, because I got so much out of it, I'm trying to return the favor. And so, you know, very often I will see wannabe GPs who are thinking about raising their fund and want some, you know, a bit of my time to just either validate a thesis that they have or an approach that they're taking, or just explaining to them how they can actually one day get into venture, which is sort of this weird industry, which is largely kind of a co-optation game where you basically get in venture because someone thinks that you will be good at it and gives you a shot, which is exactly what happened to me 17 years ago.
Yeah, I've been fortunate to kind of been a beneficiary of how much the community gives back, and even in just having this interview today with you has been a really great opportunity, and I want to thank you for taking the time, and also, you know, hopefully one day share a bottle of wine with you.
That would be great, Joe. I'm looking forward to it.
Awesome. Yeah. Actually, just one more thing, the very last thing, I promise, is that, you know, I tend to like to research guests before going into the interview, so it's not sort of cold. And, I'm here in New York for Oktoberfest, and, you know, talk to some of our GPs and other investors in the room. And everybody really emphasized how awesome it is to work with you, and that just even personally, one of the nicest people they've ever met. And so I really want to thank you for being on the show today and just being such a great guy.
Well, I'm blushing. Thank you so much for the very kind words. And yeah, well, look, at the end of the day, being a dick to people and not trying to be sort of someone who's supportive and helpful doesn't get you anywhere, right? At the same time, I want to be clear that if you talk to my founders, I think they will tell you that I'm super supportive. I'm always there for them, but I'm also tough. I'm also sort of demanding. I'm also trying to get them to be better. And I think that's what you need to find, the right balance between being the shoulder on which people can cry, or like the person who's going to do everything and anything to help you, but also the one that's going to deliver, tough love. And I think tough love is not my middle name, but that's something that I hear a lot from my founders about characterizing the kind of work I do with them. But yeah, I enjoy what I'm doing, and I enjoy interacting with people in our industry. So I'm very flattered that they sort of think I'm sort of a good person.
Awesome. Well, thank you again for being on the show. And this has been Jeff Clavier with SoftTech VC on the VentureForth podcast. If you enjoyed today's show, please subscribe to the VentureForth podcast on iTunes, Google Play Music, Stitcher, or SoundCloud. You can also follow at VentureForth Pod on Twitter for our latest updates. As always, I'm your host, Joe Mahavutivani, and thank you for listening to the VentureForth podcast.